So I want to thank everybody for coming again with these calls. Our goal is to present to everybody the people that are helping us make decisions for and become good stewards of your money. Today, we're blessed that we have a gentleman from Amundi, which is one of the managers that we use in the portfolio. It's Matt Colby, he's a CFA. We're going to talk a lot about fixed income today, which everybody gets excited about. Fixed income, fixed income. So we're just going to kind of dive into it. I think I'll start with the kind of a simple start out question. So when you're looking at putting together a fixed income portfolio, what are some of the key principles that and remember we're talking to clients too, but I'm guessing you deal with a lot of advisors. When you're talking
Yeah,
about building out a fixed income portfolio, what are some of the key principles or thoughts you're like, hey, guys, think about this, put this into your portfolio?
sure. From the advisor perspective, I don't think that being diversified means you have to own everything in equal proportions all the time. There's multiple ways you can construct a fixed income portfolio, but yeah, I think a core satellite still works very well. It's a way where you can get access to a lot of different sleeves of the market and still gives you the opportunity to, overweight or underweight different segments of the market depending on what your economic outlook is. But I do think it's important to be prepared. That means you don't want to try to figure out how you're going to access an asset class, after the event happens. For example, you don't want to be, trying to figure out how you're going to gain high yield corporate exposure after high yield corporate spreads blow out. You really want to do some of that work beforehand, so you kind of have a short list, or you're ready to go a little bit more quickly when the market event happens, because sometimes markets move pretty quickly. So I think you want to have a core satellite approach, or at least a diversified group of different managers, but then have a list of places that you can go if the market performs in a certain way. And then, for monitoring, I think it's really important to do portfolio look-through analysis. So instead of, just looking at, we have one part of our portfolio focused on this area of the market, another manager that is kind of a multi-sector type manager, you really need to look through to the underlying components of the portfolio so you can get an overview of the entire portfolio exposure, because sometimes you'll have some surprises in there, and you might have more exposure to one asset class than you might expect, just by you have 5 different line items, but if some of those line items are having the same types of overweights, you might be more overweight to an area than the other. So I think you should be able to look through to the underlying holdings and parse out how much exposure you have to investment grade corporates, high yield corporates, governments, securitize, most of the major sectors, as well as non-US dollar exposure and overall duration positioning. Then you'll get a better sense for how you're actually diversified, instead of just from a high level thinking you're diversified by having different line items.
That's awesome. So I'm glad you kind of pulled together in there. I joke around that we're a teaching hospital here, so we try to educate all the employees and the clients, stuff like that too. So you made a comment about core satellite. I think you tied it together at the end there when you brought in the different asset classes. But can you just expand when somebody hears the word core holdings type scenario? Can you expand what
Sure.
you kind of mean a little bit about that?
Sure. So, we can start from a traditional 60-40 type portfolio. I know not a lot of people just use the classic 60-40, but it's a good starting point. And the thought behind that is the two main risks that are out there is global growth risk, which is really expressed by the equity side of the portfolio, and interest rate risk, and that's tends to be more heavily focused towards the fixed income side of the portfolio. And generally speaking, if you look back through long periods of time, you've had somewhat of negative correlation in those two risks. So when there's an equity sell-off, there'd be a flight to quality, there would be a rush to high quality fixed income, and duration would help you in that standpoint. So that's really where that 60-40 kind of started from. So then if you're focusing in on that fixed income allocation, what does core mean? And core traditionally means something that has a duration somewhere between 4 and 7 years, say. And that was classically enough sort of duration to offset some of the equity volatility. Now, obviously, that didn't happen, and it didn't work out as it always has. Recently, in 2022, with interest rates going up so much, and you didn't really see some of that negative correlation, and you didn't get a lot of the diversification benefits that you had in that year. That's because we were coming off a very low place in terms of all-in yield. So now that yields are higher, we would expect that some of that correlation benefit would come back into the market and be beneficial again. So when I say core satellite, that means having some exposure to high quality bonds that have a certain amount of duration, call it 4 or 5 years, to offset some of the growth risk that's out there. But you really got to use the satellites as well, just for certain years where duration doesn't perform well. And so you have the flexibility to move around when rates change and when risk premiums change. So that would be adding something like a credit sleeve, and you can have multiple credit sleeves, one in corporate, one in securitized. You might have something that's shorter duration, and having those different buckets allows you to, if interest rates go up a lot, then you can add duration. And if interest rates fall a lot, then you could take some of that duration risk off the table by kind of quarterbacking between those different buckets. And obviously, if you have active management within the core space, they'll be able to do that on their end to some extent. But that's why the portfolio look through makes sense, because you need to know what they're doing so you can be additive to it on your side in your asset allocation.
That's awesome, because that kind of ties into the next two kind of topics I want to hit. But I'm gonna hit the one first and pivot into another one. But as you're looking at the economic environment today, what are the things that you're kind of most concerned about? And I love how you tied it in, like being able to jump to different satellites in the core and stuff like that. Well, as you're looking out there today, as regards to the current economic environment, what are the things you're like, wow, this is on my radar. This is not on my radar. What are the things you're kind of looking at?
Sure. Yeah, we can maybe parse that out into two segments. One would be the macro and rate side, and the other would be the credit component.
Okay.
And for the macro side of the equation, as important as it is to do fundamental macro research, I think it's just as important to be doing analysis on what's built into the market. For example, since the start of 2024, the Fed actually hasn't changed interest rates. They haven't changed the Fed funds rate, but what was priced into the market has radically changed. Coming into the year, the market was expecting 6 to 7 rate cuts this year, and now if you're looking at the interest rate probability screen on Bloomberg, the market's really only pricing in 1 to 2 cuts. So while the interest rates haven't actually changed on the short end, but the actual shape of the curve and the relative attractiveness, or how much you're getting paid for different assets and different maturities, has actually changed a lot. So part of the battle is trying to understand what's going to happen to rates, but the other part of the battle is understanding what's already priced into the market and trying to isolate where your opinions and your outlook differ from the general markets, because that's really what's actually going to move prices on a relative basis. So from the rate perspective, I think you can make a pretty good argument that the 10-year is about where it should be. I know that, usually when, financial media is making some sort of an argument, you got to have one strong call one way or the other that your rates are going to go up or rates are going to go down. But if you look at the two main methods of valuing that, a 10-year treasury, you could do it the build up method, which is take your GDP expectations and your inflation outlook, add them together, and that's kind of what tends to drive the 5 to 10-year part of the curve. And doing that, if you're expecting 2.5% real GDP growth, somewhere between 2.5% GDP growth and 2 to 2.5% inflation, well, that gets you kind of to 4.5 to 5% on the 10-year. So it's not a crazy number to think that that's where we're going to be going forward. And then if you do the other popular method of valuing a treasury bond, that's just looking at historical averages. And if you go back 40 years, actually the current 10-year is still under what the 40-year average is. It's slightly above the 30-year average, kind of depends on what time frame you're looking at. But any way you kind of value it, there's not a strong sense that the long end of the curve has to fall from here. Even if the Fed does cut, because the Fed controls the short end of the curve, not necessarily the long end of the curve. So that's a thought on rates. And then on the credit component, I'll be brief there, but I don't think investors are really getting paid enough to be taking high yield corporate risk at the moment. Spreads are probably 2 standard deviation tights to their averages. And that's probably just not enough risk premium, even if you're not expecting a recession coming soon. It's still not really enough to compensate you for any sort of tail event or even just kind of normal just normal volatility in the market. So I would be kind of underweight on the credit component on the corporate side.
So that was my next question, was credit. So you tied in that nicely. So that's awesome. So next thing I'm going to talk about, we try to also demystify, things that have been buzzed around. So, I've gotten a couple questions in the last, 6 months or so. There's a lot of talk around environmental, social, and governance, ESG investing. Does that affect you at all? Does it make big decision changes? Does it, I guess, because you're hearing a lot of it in the media. So
yeah,
we're trying to to somebody that's actually managing money, do these things really make a big difference or impact, or is it just kind of noise?
Sure. Yeah, I'm glad you mentioned the media aspect, because now it's really hard to talk about ESG without it being a political statement one way or the other. I would think in the long run it shouldn't necessarily be a political statement. I think the long-term outcome of ESG investing is that they are different risks that managers should be evaluating. And in the long run, companies that score well on multiple different risk factors, possibly including ESG risk factors as well, should have lower cost of capital over time. So I think there's some good elements of it, and it's brought certain areas into the forefront for attention. But I'm not sure if every investor wants to have those three risks driving the full asset allocation or the full security selection. So I think it's probably better to take a balanced approach and really be looking at all the risks, and then speaking with the client, trying to find out what their goals and values are, and then managing a portfolio around aligning with those interests.
Love that answer. And lastly, as we kind of come up on time here, what's something that you're optimistic about, that you're kind of excited about, that like, yeah, you know what, this is kind of cool. We're seeing this on the time horizon here.
Sure. So I said, high yield corporates wasn't yielding enough or wasn't spready enough to be super attractive in our book. That could change quickly. So, have some liquidity if that happens. But in the current environment, I think you want to look at some other areas of credit, some alternative credit. The securitized credit market is actually still pretty interesting because while high yield corporate spreads have grinded tighter, the securitized credit market has actually widened out quite a bit. About a year to 18 months ago, and it's starting to catch up a little bit to corporates on the bullish front, but there's still some more spread to be had there. So especially in areas like seasoned mortgage collateral. So we like finding bonds that are backed by homes purchased in 2017, 18, 19, right before that steep run up in home prices that happened during COVID and coming out of COVID, because then you could find bonds that have like 35, 40% home price appreciation built into it, meaning that you're unlikely to see many defaults in that area, even if there is a housing price correction of 10 or even 15%. So you can still find some good credit deals out there if you know where to look. It's just not always the most popular area, which is in the corporate credit side. On the rate front, I actually like the 2-year part of the curve a lot because we're still inverted, so the short end is still elevated. We talked a little bit earlier about the 5 and 10-year being more driven by GDP and inflation expectations. Well, the front end of the curve is controlled by the Fed. So if you think the Fed will eventually be cutting over the next year, then you want to have some duration. You want to have some sensitivity to that. So I think the 2-year part of the curve provides that, but it also provides you a very high probability of participating in those rate cuts. As I explained, that the 5 to 10-year part of the curve may or may not participate in the rate cuts when that does happen.
Awesome. I want to thank you for your time, for jumping on a call and doing this for our clients. We greatly appreciate it. Again, these are the people that we have access to help us make decisions in your portfolio every day. But again, I want to seriously thank you for taking time out of your day to jump on the call with us.
Of course, anytime.